The intent of this video is to provide you with an overview on how to calculate the intrinsic value of a stock. Our approach is somewhat different from other tutorials in that we take a pragmatic route. By doing so, we essentially look at an actual company. In this case, we're looking at Skechers, ticker SKX, and we will go through the underlying financial performance from an historical basis perspective, as well as projections for the next 5 years and in perpetuity. And with that said, I think we can just dive in. One thing I wanted to add before we move on to the table of contents is that if you decide to subscribe to our channel, EarningsIQ.com, you can also receive the template that we will be presenting today, and eventually you can change the assumptions. As you know, most of the assumptions are fluid in nature and with respect to the growth model that you can use and so forth, but you will have the actual underlying data coming from historical performance, coming either from 10K, like the quarterly analysis and so forth. So I would suggest that if you like the video, just subscribe, and then we will send you the file as well. And every week we will be procuring a new file covering a new company such as Apple, Facebook, Amazon, and so forth. So let's just dive into the table of content just to get an overview as to what we'll be covering in this video. We will start off with an example of an enterprise value calculation. This is a simplified approach, and we will avoid any complications in terms of discounting and so forth. And then we will also show the enterprise value calculation for Skechers, and then we'll move down the line in terms of how we came up with the underlying values to use in the enterprise value and eventually the intrinsic value of the stock. And then as we'll move on into other sections such as earnings performance, free cash flow, and balance sheet. So for you that are not familiar with enterprise value, I think we're just going to go through a very simple example. And we will assume that you're opening up a business and you're selling widgets. So you are a retail business. You're essentially not manufacturing anything, but you're buying wholesale and then selling retail. And just to give a quick overview, let's assume that there are two types of funding, either equity or debt. So let's say that when you start your business, you contribute $50 million of your own cash. So that's your equity. At the same time, you do have an option in terms of being able to get some debt from one of the local banks. And for the sake of this example, let's assume that you also match your contribution or cash contribution with $50 million in debt that was procured from one of the local banks. So essentially on day one, you will have $100 million in cash. So let's say that this is 2018. So your cash balance will be 100 million, 50 of which came from you, and then the other 50 was procured via a loan from one of the local banks. Then what that represents, or what you in theory do next, is use the $100 million in cash and buy $100 million worth of inventory, and this will be, let's say, widgets. And in getting the 100 million, your cash balance at that point at the end of 18, let's say you haven't resold that inventory, is going to be zero. But then when you move on to right before, or you move on into 2019, you sell that 100 million in inventory for 130. So in this case, but not only do you sell it for 130, but you also go back and buy another 100 million worth of inventory. So the profit from the sale and then purchase of inventory, meaning that you had $100 million in cash, bought inventory, then you you have $0 in cash, then you sell the inventory for 130, but then buy another $100 million worth of inventory. So your profit here is 30 million. So your cash balance at this point, and you have 100 million of inventory, it's 30 in 2019. And then when you move on to 2020, you keep doing the same thing. So you kind of move up with 30 million upwards. And then you're going to be only in operation all the way up to, let's say, 2027. So in 2027, though, the only difference from the other years is that you will not rebuy the inventory. So instead of having 30 million profit that you had every year, you'll have 130. So at the end of 2027, let's assume they were closed shop at that point, you will have $317 million. So that cumulative cash, without taking into account any type of discounting, that, just for the sake of simplicity, that represents your enterprise value. Now, we're not only interested in your enterprise value, we want to know what the intrinsic value of your stock is. So you have $370 million, which represents the enterprise value. On basically, if today you are able to calculate your future cash flows, that is what the enterprise value will consist of. Obviously, you need to take into account the discounting, because if you have $10 now or $100 now, a year from now with a 10% interest, if you deposit at 100, you'll have 110. So essentially, cash in the future has to be discounted at the current rate, meaning that today's basically $110 a year from now, it's worth $100 now. But getting back to this example, we have $370 million, which represents your enterprise value. You know that on day one, you essentially got a loan for 50, so your intrinsic value of your equity is $320 million. And in addition, let's say that when you started off, the $100 million or the $50 million cash contributed by you, let's say that this is actually a public company and that equity ownership is represented by 100 million shares. So we know the intrinsic value, equity-wise, 320 million. We have the shares outstanding of 100 million. Then the intrinsic value per share, basically, of the stock is 3.2. So if the stock was selling, let's say in the New York Stock Exchange, for $4, you know that the intrinsic value is 3.2. So you do have a basis of comparison, because when you combine technical analysis with fundamental analysis, you need to be aware of where the stock should be and then compare it to where it is. So the fundamental analysis will give you that overview and some sort of a sense as to where it is now. So this is a good example. I mean, I think once you get the file, you can just play around in terms of the underlying assumptions used here, but it's a simplified view as to how to calculate the intrinsic value per share of a stock. And I think we can move on to the SKX, or Skechers Enterprise Value Calculation. And in here, you'll see that everything here is pretty much, with the exception of a few items such as weighted average cost of capital and so forth, it's linked. It's linked to the different tabs to the right. And what we're trying to do here is show free cash flow. This is cash flow before any debt repayment or any. This is not levered. This is unlevered cash flow at this point. So when you think of the example that we did before, we did the same thing. We calculated the cash flow for each year, and then the enterprise value was the sum of the cash flows. So same concept. So the sum of everything here will give you the total enterprise value calculation. The only difference here is that we do have the supporting detail as to how the cash flow for 19, 20, 21, 22, 23, and so forth is calculated. The annual going forward rate, that is based on the details on the projections tab, which we will come back to it. but that is used for determining the annual cash flow in perpetuity, assuming there would be no more growth going forward after 2023. So what I mean by perpetuity is that if you think of Apple, the assumption is that Apple will continue forever. That might not necessarily be the case. They might not be an incumbent firm in the future. But the assumption that you take on now is that it will exist in perpetuity. So that 376 means that they'll make about $376 million in free cash flow. So this is cash flow before any debt repayment or of that sort. The enterprise value for the first 5 years of projections are included in this cell over here, and then the 3.4, because this is in millions, so that's going to be billion. It's calculated based on a very simple formula where you take the total annual cash flow, which could be considered a dividend, divided by the interest rate, which is the weighted average cost of capital, or 11%, less the growth. And then you can see that the growth here, it's stated at 0%. We assume 0% just because we don't want to complicate it. Eventually, you can play around with numbers in terms of what your growth assumptions are. One thing that I want to mention is that the weighted average cost of capital, I mean, this is essentially your opportunity cost. This is where you're giving up. Like, what's the minimum return that you need to invest in X, Y, and Z in a certain company? So, and that's made of two components. Weighted average, it's a weight between the cost of capital in terms of both equity and debt. For simplicity purposes, we used 11% that came from GuruFocus.com. So that's something that you don't necessarily need to calculate, but if you do go into detail, and we can do so in one of the upcoming videos, we can, in theory, go through a very detailed analysis on how the weighted average cost of capital is determined. That has large implications because the 3.4 billion here, so keep in mind this is all in millions right now. The 3.4 is highly impacted by that weighted average cost of capital. So depending on where we are in the economy, where the interest rates are standing now, and so forth, that number, the 11%, has somewhat of a large role. So I think, so this is a relatively simple example. One other thing I wanted to mention is that in addition to the actual cash flow, we show the present value as well for the first 5 years. The 3.9. So in this case, we didn't use the present value of future cash flow in terms of this calculation, but you can easily change it, right? So instead of using the actuals, which that's what we use in the enterprise value example, without looking at the discount, you can do the same here at 11%. So just for sake of changing this, I'll just put an A in the total top. So this is it's a template. It's relatively easy to use, so you can do so. But in this case, I think we can just use the present value future cash flow. I think initially we left it at that, just not too complicated, and to correlate it with the example before, which is a made-up example. But in this case, these are actual numbers, and you can clearly see the calculations on each one of them in terms of present value. And once we have the enterprise value calculation, we have the debt and debt-like items. The debt and debt-like items are coming from long-term borrowings as well as current installment of long-term borrowing. So that 90 million is essentially that 88 plus 2. Now, you could deep dive into the analysis on the balance sheet side and figure out what other liabilities could be considered debt-like items. In this case, we've just assumed that the only thing that in the long-term basis you'll have debt-like items of debt and debt-like items of about 90, but eventually you could consider the other long-term liabilities. That could include pension, that could include other items. So we have not included it in there for now. but the difference will not be overly significant in terms of totals. So I'm going to go back to the calculation itself. So we end up at 31, and then we have a current cash safety. What I mean by that is we have 156 million of shares outstanding, and we also know that as of December 18, the company had cash and cash equivalents of 872 million. So we divide 872 divided by 156, you get $6. So in addition to calculating the intrinsic stock price, which is based on the intrinsic value, equity value, divided by the shares outstanding, you also have a cushion because the company can pay back that 800 million or so that we mentioned earlier. So your true value, it's about $37 per share, as opposed to the 31. So you do have some cushion. I know that Skechers recently has fluctuated quite a bit. And in fact, every quarter when the earnings releases come out, Skechers has moved up or down by at least 20%. So that in itself gives me some options in terms of how to trade it as far as options trading. Because in theory, if you play the spread, meaning it would move within a certain range, then as long as the stock moves outside of that range, you'll be making a profit. And in the last 5-6 quarters, if you played the spread relatively close to the earnings release date, you'd actually have won on almost every case. So and that's a discussion that we can go through on another video. I think for now we just want to go through the intrinsic value calculation and provide you with a tool to do so for Skechers specifically, and then you can use it for other companies as well, but eventually we'll provide a separate example for other companies out there such as Apple, Facebook, Amazon, and so forth. Now I'll keep moving on to the details, projections. I'm not going to spend a whole lot of time here. One of the reasons why is because you will have access to this file. And let me just go to the top. So the way that this is set up is that at the top you'll have the dashboard where you can expand or group everything together. And at the bottom you'll have the projections. The historical financials such as the sales, your earnings, adjusted EBITDA, and so forth, those will be linked primarily to the tabs to the right. And then the assumptions are all included in the dashboard expand to view section. And just going through a quick overview, essentially we're projecting sales, adjusted EBITDA, D&A, which is depreciation and amortization, earnings before interest and taxes, effective tax rate and actual tax, and then we go all the way down to the free cash flow unlevered. And then that will roll up into the SKS Skechers, which is your final calculation. But in essence, once you get this file, you can play around in terms of what your growth assumptions are and so forth. We know that in 2018 versus 2019, the sales grew by 11.5%. We assumed that it would slightly go down year over year all the way to zero to the terminal value, right before the terminal value, and going forward that would be zero, so there would be no further growth. Same thing on EBITDA, we used the last 12 months, and these are actual 2018 numbers, the 4.6 billion and 571 million in profit, and actual adjusted EBITDA percentages at 12%, and then we assume that this number would go down a little bit, 5 point, let me just look at this, is about 9, so from 0.9%. So we're going from 12.3 to 11.4, 10.5, and so forth. We are using some other items in terms of determining the trading working capital in the future. So what that means is their accounts receivables, payables, and inventory. And we're using the days sales outstanding and days in inventory, as well as days payables outstanding. Those are things that typically you don't see in typical financial sites, but they are somewhat necessary if you're trying to get a sense of where your free cash flow are. The calculations are relatively straightforward, and you can follow the links. So we show the cash conversion and where it's coming from. So if you follow the details, you can see that how we're calculating the days in inventory and so forth. So I don't want to spend too much time because you will eventually be receiving this file if you decide to subscribe, and can leverage the information that's included there. But so most of the detail going from this tab and forward consists of the information that is necessary to build up the enterprise value. So the next few tabs, so this tab, as mentioned earlier, you'll have a dashboard where you can expand, change the assumptions if you see fit. At the bottom, it will calculate the projections all the way down to the free cash flow. The EBITDA percentage, that's used basically as a starting point, as a proxy for your FY19 and forward. As mentioned earlier, in the projections, you can change the adjusted EBITDA assumptions as you see fit. So if you go at the top, you can change it from, let's say, you're typically you'd assume that as they grow, as SKX or Skechers grows, they're not going to be able to maintain the same cost structure. So essentially, that might either way in terms of earnings, and then your adjusted EBITDA percentage will go somewhat down. So I'm going to move on. So the cash conversion cycle was used in the projections as well, and earnings performance. So the data that is used to build up the previous tabs, it's largely included in this section. So here you will see the full set of financials, which is presented in millions by quarter, going back to March 16. And to the right, you'll see the annuals. We've not included March 19, but we will do so. And once Q2, once the company releases the earnings for Q2, we can also include that in 19, and then look at the last 12 months. But essentially, for now, we're showing 15, 16, 17, and 18. But on a quarterly basis, we're only looking at 2016 and through 2018. So you can see all the KPIs or the key performance indicators in terms of what the earnings are as a percent of sales and so forth. And then at the bottom, you can see the margin trends as well. We can spend a lot of time going through this tab, but I think it's easiest if you take a look through the file once you get this file, and you can play around in terms of not necessarily play around, but just look at the economic trends. We'll show a couple of charts to the right of this tab here, and so forth. So in here, we're showing a sales walk. So from 2015, they have 3.1 billion, about 13% increase in 2016. Majority of it's volume price, but the more you deep dive into the financials, in let's say 10K or 10Q of the company, you can draw in more conclusions, but in essence, you're just trying to get a baseline view as to where the stock should be. So I think it's not necessarily very effective to go through all the 10K data and so forth and the footnotes that they show. So for now, I think if I was you, I would just stick with the data that's included here. Um, then the next tab, it's a sales and gross margin percent annual trend. In this case, we're showing the bars are showing the sales, and then the line is actually showing the gross profit as a percent of sales. So this is just sales and cost of goods sold. So there's nothing else showing up in terms of the gross profit. The back-end supporting costs such as selling and administrative and G&A, basically general administrative, are not included here. But if we move on to the next tab, you can look at operating income, which is basically sales less cost of goods sold, and then less is G&A. That is going the opposite way. The trend is going the opposite way, which means that their back end support costs are somewhat higher going forward, or in 2018 versus the earlier years. So they're not very efficient at this point in terms of the back end cost. And then this is net income. So in net income, we also include, in terms of calculating net income as a percent of sales, you are also including the tax impact. And you can, if you remember, in 2018, the tax reform hit. So essentially, you do see upward movement in 2018 versus the downward movement from 15 to 17, because your 18 taxes were somewhat lower based on the new enacted law. And there's also a quarterly trend, net sales, gross profit, and profit as percent of sales. It fluctuates primarily due to seasonality, so I would not concentrate much in this section here. And then this is a tab which will show free cash flow historically. This is what we used 18 as a proxy, as a starting point for the future, but in this case we show a very detailed calculation on how to calculate free cash flow. Majority of the information here is linked to the other tabs. We will have a separate video where we will go through an actual calculation of free cash flow in much more detail, and how you should look at the 10K, 10Q reports and pull in the data. Again, keep in mind we will be pulling in the data on your behalf. But I mean, as you can see, we are pulling in the data from the balance sheet in this case. So when I go back to my free cash flow calculation, the 84 inventory, changing working cap, we're doing the calculation straight out of the balance sheet because there's a separate tab to do that, and taking out any non-cash items as well. But I think the intent is not to go through line by line, but just to show you the template to calculate the free cash flow by quarter for 17 and 18. And then what we also include in this file that you can play around with, it's a balance sheet showing both current and non-current assets and liabilities, and then the equity balance. So essentially, this is done on a quarterly basis as well. Lastly, in our upcoming videos, we will also go through an economic, or a view on the GDP, or not necessarily GDP on its own, but where economically where we stand in the U.S. And there are many items that can be looked at. One of which is the imports less exports. And we'll take a look at where were they trending in 2008 and prior, and so forth. So this is just a snapshot. We're not necessarily going to go through this, but basically we will look at a specific example of how exports and imports were looking prior to 2018. And going back to 2008, and then prior to 2008, where we had in 2008 we had the economic downturn. So essentially, we just want to look for trends to avoid being in the market during an instance where there could be a downward trend. So essentially, I think there are three things that you need to look at. It's basically economically where we stand, the fundamental analysis in terms of when you look at a specific stock, and then the technical analysis. All three of which we'll cover in more detail in the upcoming videos. But I think for now, this will end our session. So thank you again. I appreciate your time, and there will be more to come.